That's Donna Lewis, and I love you always, forever. It's the Morning Drive with the Flying Dutchman and Gillian. Lavinia off on leave. We are live on Facebook with our special guest, and this is his last day with us, Matthew Nixon, financial expert for Financial Literacy 101. Thank you, Matt, for joining us one last time.
Thank you for having me, as usual.
It's been so good having you here, and this is the last one. We were talking about it this morning. We were going to go, what are we going to do without your slides?
Well, it was a very quick 10 weeks, and I'm glad we got to cover a lot of important topics. So today is one of those ones where I think we've kind of talked about the four main pillars, now we talked about, savings, debt, and now we're going to talk about one as well today, which is probably the most important, which is investing, which is probably the more complicated one.
And also, I think a lot of people need to be able to differentiate between what is investing and what is gambling.
Yes.
I think that's really, really important. But as we always do, I guess we're starting with one of your pop quizzes.
And sorry,
I'm
today
not
it's just you today. So
it's all me.
Okay, these ones you've invested yourself, so these should be pretty straightforward.
Really, we'll find out whether I've done the right thing.
Okay, so question number one: before investing, what's the most important thing to understand? A, which stock your friend recently made money on. B, how to time the market perfectly. C, your own financial goals and risk level. And D, which investments has the fanciest marketing?
I would say C, your own financial goals and risk
level. You are 100% correct. So you need to know your own financial goals and risk level. So investing, I think, is very personal. So knowing your goals and how much your risk can tolerate is very important, more than just chasing stock
True
tips.
Enough.
Yeah. Okay. Question number 2, what is the biggest mistake people make when markets drop? A, buying more immediately. B, selling everything out of fear. C, doing nothing. D, switching to cryptocurrency right away.
See, here I'm torn. I don't know whether it's B or C. I would tend to go with B.
You are 100% correct. Selling out of fear. So historically, staying invested and dollar cost averaging performs better than panic selling. Just for those for asking what dollar cost averaging is, it's an investment strategy where you invest a fixed amount of money on regular intervals into particular assets regardless of its share price. So you're averaging over time. So we'll talk more about that than if it's better to do dollar cost averaging. Right. But staying in the market, I think a very good example is very recent history. When Trump announced the tariffs in April, the market went down 25-30%. Those people who got out have now missed out on all those gains that have gone through the rest of the year. So by panic selling, you're really doing yourself a disservice. So just kind of write it out. And we'll talk more about risk tolerance. But before that, I got one more question. This is a true or false one for you.
Okay.
Investing in the stock market is the same as gambling because both depend only on luck.
I disagree with that because I think investing, when done properly, there is a bit. I do believe there's a bit of luck in it, but there's also a lot of research that you need to do before you invest.
100% correct on that one too. Yeah. So investing is research-based, long-term growth, understanding what companies you're buying. Gambling is pure chance, no strategy, no ownership. And with investing, the longer you stay in, the more the odds work for you, not against you.
Right. Yeah. All righty. So we are going to talk about a lot of different things. Investing, how it differentiates from gambling. How do you know your risk profile? What kind of investor are you actually? And what are the safest investments for beginners who don't want to lose money? Keep it right here with us. We're going live on Facebook. Okay, so we're live on Facebook, and let's get down to the nitty-gritty. A lot of people, every grandmother will tell you, you want to invest, it's gambling.
Yeah.
The older generation, every investment you make is gambling. And to a degree, I've got to say, even with research, there is that element of luck. There is a gamble to be taken, but investing isn't quite gambling, is it?
Correct. No, it's not. So I think what I really want to focus on is these two camps, right? There is the people who are scared, intimidated by investing their money, and they're missing opportunities.
Yeah.
So I really want to dispel the myth that it's too complicated as well. And then you have other people who think it's gambling because someone goes in and they'll go and buy a bunch of cryptocurrency, and then the markets drop and they lose everything instead of a gamble.
Yeah.
So what I really want to focus is on a few things here. So 5 points to where really I want to clarify where investing really is. Number one, investing is based on strategy, and gambling is based on luck.
Okay.
So when you invest, you should be researching, planning, doing long-term goals. Where gambling, you're just hoping for a quick win by chance.
Right.
So number two difference is investing grows wealth over time. Gambling tries to win money instantly. So when you're investing, you're actually building gradually through compounding, dividends, business growth. Gambling is just short-term, automatic, immediately, usually a negative effect. Number three is investing manages risk. Gambling ignores it. So investors diversify across many assets. So you can buy stocks and bonds. You can select different countries, different sectors. Maybe you're into tech. Maybe you're into oil and gas. Gamblers just put everything on one outcome, win or lose. So that's another difference. So number four is investing has positive expected returns. Gambling has negative expected returns. So what I mean by that is financial markets usually grow over time, sometimes even 7 to 10% per year. Casinos or betting companies, designed for the house always wins. That's what they're designed to do.
Yeah, otherwise there'd be no business.
Exactly, yes.
Yeah.
And the last point, number five, is investing creates value. Gambling transfers value. So when you invest, you're actually funding real companies, innovation, and economic growth.
Okay.
Gambling is just moving from the players to the house, so nothing is created. So that is one of the final things. So when you're actually investing into the markets, you're actually helping the economy grow. You're investing into a company by buying the shares of stocks. If you're buying bonds, you're buying debt from a country, whatever, to help them prosper and grow. So that's a real big factor.
So am I right to then say that if you're investing, it's always long term? There is no such thing as a short term.
You can do short term. You can do short term, and when I say short term, there's day trading. There has been there's ways to do it safely, but there's our day traders that do trade the market daily. That one is a very good skill. I'm talking more to those out there who are really wanting to do long term. So they're looking at what their plans are like 10 years down the road, 20 years down the road, even 3 to 5 years down the road, because buying a stock right now in the market is not going to get you rich in 3 months' time. It's just not going to happen.
Yeah.
You might go up, might go down, but you really need that kind of window to let it kind of ride 3 to 5 years, go through the business cycles. 10 years, 20 years is even better. You talk 30 more years. So if you're in your 20s, 30s, and talking about that long retirement age we've talked about, that now people are living to 86, 90, even 100. This is where you start buying companies that you feel comfortable, or buying investments that is going to have long-term growth. Yeah. And that is just knowing the strength of the company, knowing, your blue chips, or, there is times to take risk on new companies. There's venture capital investing as well. But short-term daily trading, that is a skill that you need to really hone and be prepared, because even the best day traders will lose lots of money.
Yeah, when you lose, you really lose.
You lose, yes.
Yeah. I guess I heard something from someone else who's been on the show when it came to buying a house. He said, you've got to think of where you're going to be 10 years from now. What's your family size going to be, blah, blah, blah. Is it the same with investing?
It is.
It is, right?
It is.
You're thinking where you're going to be 10, 20 years from now. Yeah.
I think where the really good mindset to have is that you're going to have we talked about this before. So one of the pillars was budgeting. That was one I forgot to mention at the beginning of the show.
Yeah.
Budgeting is good because you want to have that 20% great, 10%.
Yeah.
That's the money that you're willing to put aside and park and say for a rainy day. So that's where you really need to have either yourself doing the research of where you want to put this money in, or you get professional help so that they can look at what the growth is going to be, because you're going to have different ways. We saw the last 20, 30 years how China has gone, crazy, and that was a good place to put your money into. Yeah. And then the housing overhousing happened, and then the economy came down. They're trying to reboot the economy, so that the Chinese stocks took a bit of a hit, right? Where right now America's growth is, everything is very pro-America growth. And I think another thing that can be kind of a global way to look at investment is, the AI boom, data centers. And when you start looking at things like this, it is you look at the companies that have the future growth that are going to be there. So those are the kind of the technology companies. But they were saying that if you looked at the companies that actually were building the data centers prior, like the construction companies, those stock prices have gone up too. So if you catch the right news and the right trends before that kind of explodes, then you'll kind of build on this and have good ideas to invest in the future.
Okay. When it comes to all this investment, profiling yourself, I guess, is kind of important. You need to know what you, I guess, are comfortable with, what your risk profile is. So how does one find out your risk profile? How do we find out what kind of investor we actually are? Oh, I tell you what, let's hold that idea. We'll do that one when we go back onto radio. So remember that if you've got any questions, put them through on our Facebook. We'll try and ask Matt as many as we possibly can, although we do have a lot of questions to cover today as well, okay? So we're going to go back on air to try and discover how you risk profile yourself. In other words, to find out what kind of investor you actually are. Tony Basil is who's playing on radio right now. So Mickey and Tony Basil, that's what we've got on the morning drive. We are talking to Matthew Nixon, our financial expert, and we are talking about all things financial. We've covered already the difference between investing and gambling. Now we're going to look at how do you find out your risk profile? What kind of investor are you actually? How do we do this?
That is a very good question, and I kind of just want to bring a personal note is that, and you've gone through these two events. I've gone through 2 black swan events in my lifetime. So that is when there is a huge market crash of 25-30%.
Yeah.
So the first one was in 2008, and I was at that time 28 years old. I didn't feel the effects really of that.
Okay.
And then all of a sudden you fast forward to the COVID-19 after the pandemic and you have another market crash. Yeah. And then in your 30s, 40s, you're like, it's a bit more, you kind of clinch to where like, I've just lost, years and decades of savings.
Yeah.
So I think the 2 profile questions you need to ask yourself is, can you take the risk and can you tolerate the risk? So what I mean by this is risk versus risk capacity. Financially, can you afford to take the risk on what you're investing into? And second one is risk tolerance. Emotionally, can you sleep at night when the markets drop? So a way to really check yourself, I've kind of curated 5 different questions of how you can do a quick check on your risk tolerance profile level. Okay. So one is, what is your time horizon? So when do you need this money? Is this like a 0 to 3 years? Then you'd be more conservative and you'd actually have a conservative risk tolerance. If you're long 10 years, take more risk, then you're more growth aggressive. Number 2 is income stability. You really need to make sure that your job is stable. Do you have an emergency fund saved up? And if income is shaky and no emergency fund, then I would taste very less risk adverse. Okay. Number 3 question to ask yourself is, what is your experience with investing? So if you're new to investing, you need to start more conservative, look at simple products. As you get more experience, then you can start going out and providing more complicated products. Number 4 is how do you react to your losses? So this is a big one. So you need to be honest with yourself. If your investments drop 20%, what are you going to do? So one is, I will panic and I want to sell everything. That means you're conservative. So conservative in detail means you actually hate seeing losses. You prefer stability. You're okay with lower returns, and you need money sooner. And your goals are important to you, your midterm, your short-term goals. Okay. Then if I'm comfortable and can hold, that means you have a balanced approach. So that means you can accept some ups and downs, can tolerate short-term drops. So you have a mix of growth and safety. And then you have the other mentalities I can see, as a chance to buy more. When the markets drop 20% and you're putting your money right into the market, that's the aggressive mentality. So this is your long-term horizon thinkers, you're comfortable volatility, and can focus on long-term returns with the big swings that you make. Okay. And final question is, what is the main purpose of your money? So are you using this for a down payment on the house? Are you using this for your kids' university, 3 to 5 years, retirement, 20 years? So the more important and the near-term goals, the lower the risks you should take.
Okay. If I'm a beginner and I really don't want to lose money. What's the safest for me? Is it invest a lump sum or dollar cost average?
Okay, so to answer the first question is if you're really a new beginner at investing, look at money market funds. Singapore saving bonds are very good. Fixed deposits with known banks because you're going to get low returns, but they're going to be guaranteed returns. And this is a good way to kind of kick off that kind of investing. Okay. If you're a bit more risk adverse, you can start looking and kind of have conservative, take a little bit more risk. Look at unit trusts, passive ETFs. An ETF is exchange traded funds. So this is where a fund manager will take a basket of investments, a basket of companies and track it against a benchmark. So an example of that one is the Philip Sing Income ETF, which is good. So that's, if you don't want to buy every single stock in Singapore and you want exposure to like the DBSs, UOBs, Singtels, then that's what you'd buy. You buy an ETF and that will track for you and you'll get income and you'll get the growth of those companies. Another thing too, and to answer your question, is it better to invest in a lump sum or dollar cost averaging? So here's a simple rule of thumb. If you have a big lump of sum of money and you're quite new and nervous, use dollar cost averaging and invest that lump sum over 6 to 12 months, because then you'll be able to diversify. And as you understand risk a bit more, then you'll have your long-term horizon, then you'll be okay to start putting down more lump sums. But actually, lump sums can have more mathematical sense of getting bigger gains at where you invest in the market because your time horizon might be further along. Yeah.
Okay, stay with us. We're going to go on to Facebook and figure out whether you pay your debt first or start investing first.
The Morning Drive.
Here we are with Matthew Nixon, our financial expert on financial literacy 101. We're dealing with so many things this morning. And the question we're asking now is, should I pay off my debt first or start investing first? Or can I gradually pay off my debt and invest? There's so many permutations.
Yeah. I want to be very clear. So with the credit card rates being as high as they are in Singapore, it makes no sense to have a 20% credit card rate and then you're going to invest and try to get 10%. So rule of thumb, always pay off your credit card debt first. And if you're putting all that money, you're not able to invest that 10, 20% that month, that's fine. Get that debt down. And I think you and I have agreed about this. Credit cards should be used for emergency purposes only.
Yep.
Yes, you can get some nice points. You can get air flyer miles. That's great. But really, credit cards should be there for, last gasp of, use a debit card instead, because a credit card is just you're always going to feel like you're trying to catch up. And then you're like, well, I'll invest next month and I'll invest next month because I got to pay off credit card bills. It becomes a habit. So you need to just change your habits.
It's interesting because I was talking to someone the other day and they were going, but with the world going cashless, you're going to use your credit card. It's not going to be an emergency thing. And I was trying to explain to them, no, you have a debit and a credit card.
Yep.
You live off the debit card.
Yes.
You don't live off the
money
credit
you have,
card.
Yeah.
Yeah, it's money you have. That's what you live off. When it comes to investing, which is smarter? Use my CPF, use my SRS, or use the cash that I have in hand?
Okay, so this is a very good question. And I've always been a very advocate throughout the last 10 weeks on investing in your CPF. But there is one easy rule of thumb on how you should do this. So remember, your CPF is money you cannot touch, and that's for retirement and housing. Your SRS account is a tax saving, retirement, so for top up, so it's not easily touched. So cash is where flexible money for use for emergencies and investing. So if you have a long-term retirement decades away, then yes, utilize your CPF, utilize your CRS. If you've got a midterm goal, so next 5 to 10 years, it's better to go with cash investments, not CPF and SRS. Okay. So if you're thinking about doing a house renovation, further study, starting a business, invest with your cash instead of your CPF and your SRS. If your short-term goals are 0 to 5 years, then don't invest aggressively at all. Use your cash and put those in safe places like high yield savings, Singapore savings bonds, fixed deposits, because your CPF and SRS are going to be too locked up for that in the short term.
Okay, a couple of questions coming through on our Instagram. Our Facebook. Sorry. Is it healthy to invest in ILP with 10-year maturing when one is retired? ILPs come with a lot of charges in the fine print.
I have very strong opinions on ILPs. I think they can be good in certain situations. If you're retired and you have a 10-year plan, they just eat away fees.
Yeah.
So it, to me, is a very high-risk situation. So ILPs, yes, you can invest in certain underlying funds. Those funds have the chance to actually grow. But an ILP, I would be looking at for more as someone who's got more of a 20-year plan to grow it, because your ILPs are there's a lot of charges, underlying charges in those, and sometimes 3 to 5%, even more. So the markets have to outperform that, and the markets have already done very well over the last decade. So there are times when there is going to be recession, there's going to be downturns, there's going to be years you're going to get negative. We saw one in when the COVID pandemic hit in 2021, 2022, where everything was like negative 20%, and then things go up.
Yeah.
So if you're in an ILP and you're not gaining and your underlying funds are not performing, you're just going to be those fees are just going to be eating away anything, and then there's going to be a longer way to catch up. So I would say for ILPs in that circumstances, don't do it.
Another question coming through: what can be categorized as simple, and what is complicated stock?
So this is where. So I was kind of. We're going to talk about this. So if you have a growth stock that is something that is really trying to beat earnings, it's something new to the market. Always look at how the earnings are on the underlying. So if you have a stock that's been around for quite some time, I will give a very good personal example. Apple many years ago, before when the iPads and it was more of a computer company, and then it kind of went in and started growing. Apple to me is a very safe stock because you're going to have iPhones and there's going to be cyclicals, but they're also developing, and it pays. Stock companies it pays a small dividend. Apple does, but at least it pays a dividend. So companies that are able to produce and give back some of their earnings are good companies to invest in. If you're going for a speculative company, like when OpenAI hits the market, it's still a public company. It's probably going to have a lot of money go into there, but people are planning on that going to be the game changer. So when you see like these new, and I've lived through, we've lived through like the Googles coming on board, the Facebooks. People would never say like, why would I invest in Facebook? It's a social media kind of way. Well, look at them now. They're one of the biggest marketing revenue generating, with Instagram, Facebook. So you need to kind of look and, look what's common in the world today and where the trends are going, and look at those companies that are driving that innovation that are going to be the future. If you want something that's been around, been there, done that, kind of controversial to say, but the petroleum oil stocks that are pay 6-7, but they are looking into doing greener investments and things like that. So look at your blue chip stocks for the safe that So if you're in Singapore, the financials are always quite strong. OCBC, DBS, Singtel. Keppels of the world that are always going to have some sort of tied to the infrastructure, and it's going to be daily use. If you see something that's really trajectory, that's going to be like, I think green energy was, quite popular during in the United States before Trump took over, because he was more about an oil base. So you really need to take those kind of factors in. But look what's been there, done that, has a good track record, and go into that as a conservative stock. Okay.
Here's a question I'm sure that's on the mind of a lot of Singaporeans. Is it possible to beat inflation in Singapore, or are rising prices just unavoidable?
Okay, so this is a very relevant question for today. So what inflation means to you is, what's going to happen is that every year you're going to go to the hawker stall, your chicken rice, your prawn meat, it's going to go up in cost a bit more, okay?
Yeah.
So what you really need to be cognizant of is that the money grows slower than prices, and you need the money to go. You actually need your money to grow faster. So that's where investing comes in. So if you have the mentality where I'm going to put my money into a bank savings, you're going to get very low interest, which is going to be below the inflation rate. So let's say inflation is going to be 3% a year. Bank interest is going to be maybe 0.05 to 1% a year. You're already losing purchasing power in the future. So this is where investing is very key. So I've put together a very quick 4 ways that Singaporeans can actually beat inflation.
Okay.
So one is investing in diversified funds. So over many years, just get a broad mix of stocks and bonds, and they have historically actually returned better than inflation. So there's going to be up and downs, but long term, you're probably going to go up, most likely. CPF, especially your special account and retirement interest, this is paid. These are attractive rates. We've talked about this throughout. 4, 5, 6% when you get into retirement. So those are set up for Singaporeans to beat inflation. So make sure you're contributing to those so that when your retirement age, you have that lump sum in there. So that it's going to track inflation. It's going to beat that inflation number. Number 3, Singapore savings bonds, T-bills, good fixed deposits. So usually these are very low risk, right? I've got very good ratings, by the government. AAA, and sometimes now interest rates are coming down, but usually the rates are kind of on par, so they will be kind of tracking, so you'll be getting some. So when rates do go up, really kind of go into these vehicles, because then you're going to beat inflation as well, and that's another way. And finally, we've talked about this before, is investing in yourself, skills and earning power. This is very underrated. So your income will grow faster than your inflation. So because once your skills improved and you've kind of taken on to Skills Future, you learned something else, ask for that promotion at work if you've been kind of stagnant for years, because that is the best way to be the inflation beater, is to have your income grow.
So we heard this come up in the question earlier from Facebook about ILPs coming with large charges in fine print. How do I know if a product is going to have high fees or charges? Do I just ask, and are most people honest enough to tell you everything?
So if you're going to DIY and invest yourself, and you're not going to go through a financial advisor, a financial advisor has to tell you what their fees and charges are. That is a must. That is regulation by MAS. If you decide to go in and said, well, I'm just going to go and invest through one of these platforms, robo-advisors, always shop around. Make sure what you're getting charged on your platform fees. If you're investing into a unit trust or an ETF, there's some very good websites out there. Fund Smart Market is one, where you can actually get the fact sheets, and you need to look at really where management fees are on the fund, and you need to look at expense ratios. So an expense ratio is really basically how much the fund is going to charge you on top of your investment in there. Right. So usually below 0.5%, that's usually cheap. That's really good. ETFs, some of them are 0.3%. So that's, like I said, you're investing into a basket of companies that's been picked, and it tracks a benchmark for passive. There's active ETFs, but not going to go into that one right now. If you're seeing 1 to 2%, those are the more expensive ratios. Okay. And then if you see anything 2%, you need to kind of pump the brakes and be like, why is this fund manager charging 2%? Yeah. So fund fact sheet. Go to the website if you're going to do it DIY. If not, ask your financial advisor.
Markets drop. What should I do? Should I just hold? Because I've often wondered, what would I do? Major crash, what do I do? Do I just hold it and, okay, I'm fine for the next 10 years, I'll hold on to this? What should we be doing?
So if you want to take one of the greatest investor quote of all time, Warren Buffett, he has said, be fearful when others are greedy and be greedy when others are fearful. So Berkshire Hathaway, they hoard cash, and they kind of get knocked for this. But and this is why an emergency fund is good. If there is a chance and there's a black swan event and there's a massive dip, this is where you really accelerate your investing power. So I would say is that you look for, if there's a drop, you wait a couple of days, But if you see a 20% drop and you've liked the stock and you just have not been, or an investment that you want to buy and it hasn't got there yet, you need to jump in immediately, and you need to buy in these times, because this is where you're really going to accelerate your gains long term.
Long term.
Yeah.
So just when the markets drop, look at what could possibly be making you money in the future and buy into that.
Yes.
Okay.
Yeah.
Don't sell out.
Do not sell out.
Don't sell
Do
out.
not sell out.
If you're listening to us and you're a beginner, stay with us. We're going to go on air and find out how to build a simple, fuss-free beginner portfolio without spending hours researching it. Wrapping up another throwback on 1FM 91.3. Yet another amazing throwback here on 1FM, and it's something we're very, very proud of. We have a question from Facebook, which we will bring up in a while. But first, I'm a simple person. I'm a beginner. I want to build a simple, fuss-free beginner portfolio without, spending half my day researching everything for 2 weeks,
Yeah. Okay, so if you're a first-time investor and you're just beginning, you need to ask yourself if you're very cautious, and that means I really hate seeing losses, you need to ask yourself that question. If you're in between, I don't like losses, but I can tolerate up and down. And then if you're okay with the big swings and long-term growth, that's what you need to do. So you need to define your risk tolerance profile at the very beginning. Now, you don't need to go and pick 27 stocks and 10 ETFs and buy a bunch of bonds, okay? Beginners just do very simple methods. There's option A. This is the super lazy method, but it's a one fund solution. So you go out, you pick one global diversified fund that covers a bunch of different countries, a bunch of different sectors. All the asset managers have them, and you go and you put money into that. Okay.
What's the returns on that like? Is that a modest return or?
You can get sometimes if it's maybe Asian markets, you can sometimes get 4 to 6%. If you get global, I've seen some from BlackRock and JP Morgan pay dividends of 9 to 11%.
Wow.
Yeah, but you also got to realize there might be capital depreciations on that, because if companies in those funds are not doing well, then they'll have to sell some of that company stock in that in order to pay those dividends.
Yeah. Okay.
Now, option B, and this is where I kind of like telling people as an advisor, is let's stick with 2 classic funds, 2 to 3 funds. So you get a global stock fund for growth, get a bond fund for stability, and then if you want another one, get a local stock for flavor. So maybe like maybe like the Japanese market. Maybe you think China's going to come back up. India's been very popular. India's growing quite. My old boss was always, he was from India, and says, if you put money into India every once a year, you're going to get 6-7%, and that has been very true. I know India took a bit of a hit lately, but if you really want a simplistic split, is that if you're a cautious investor and you're new, 40% stocks, 60% bonds. If you're balanced and you're okay with some up and downs and volatility, 60% stocks, 40% bonds in your new portfolio. And if you're aggressive and you want the growth, go get 80% stocks, 20% bonds.
Okay. There's someone sent in this. I don't know whether you can answer this. If you can't, just say no. It might be more of a psychologist problem than anything else. There is a school of thought that we should live like the world ends tomorrow. How do you get someone out of that belief? My brother lives in debt and spends freely because of this. Should we be? Is that a way to live? I mean, when it comes to investing, take it from an investment point of view.
From an investment point of view, no, because it's eventually going to catch up with you. If you're running up credit card debt over and over again, eventually the banks are going to not give you any more credit.
Yeah.
Then you go down that path of taking out loans, and the worst part about that is that you don't want to drag in family members and loved ones into that situation, because it's a bit of a selfish mentality. But the stats are proving if you're in Singapore, you're going to live. Majority of people are going to live live to 86 years old. Men maybe 81, 83, women 87. So you have a long life to live. So do not live every day like it's the last one.
Yeah.
Maybe you can kind of be free like that in your teens and your 20s, but you don't want to be working into your 80s and 90s to pay for your debts, right? That you've run up in your early life. So
that's true.
Yeah.
We don't have a lot of time left, so I do want to ask questions that I feel are really, really important here. How long, realistically, does it take to get results? Shall we do that when we go back on Facebook? Okay, so let's go back on Facebook, and then we'll deal with that. How long does it take to actually see results?
Good time.
Okay, so realistically, if I'm investing, how long is it going to take before I can say I'm going to see results? Is there any formula?
Okay, so this goes back again. So investing is a very personal decision, and sometimes that people are holding themselves back from actually making those decisions, and that's where they need the help of a professional or someone they can trust on doing this. So if you think about the long-term guide, is that if you're let's say 10 years track record, if you're very safe and you just want to keep cash and you don't want risk, you're probably going to make 2 to 4% per annum over that time. And that's fine if you're in your 60s and 70s, right? Because you've accumulated that part in your life. If you're a younger person, if you're in your 30s, 40s, and 50s, you need to take more of a balanced approach, and you really need to get that mix of stocks, bonds, and I say, take the ups and downs, because that will get you 4 to 6%, right? And that's a good kind of way to grow your wealth. It's not fantastic, but this is why investing is in your life so early in your 20s and 30s, because that growth is where you're going to get 6 to 8%, because you're really going into more stocks. You're really going to that. So I would say there's going to be years where you're going to stock market's going to make 20%, and then there's going to be years that it's going to make 20% negative, So over time, and you've got inflation to worry about. So you really need to give yourself a long runway as much as possible. But if you feel like you're started too late in life, start doing it today. Start making those steps. And like I said, build that small little portfolio. Start putting in what you can contribute, because that is going to pay off long, because you don't want to wait till you're 50 and be like, oh my gosh, I've got no money to save up. So really start looking at your risk tolerance and start really putting that money to work as soon as possible.
Two terms, which one is more true? Timing the market or time in the market?
So timing the market sounds clever, but it almost never works. I mean, you really have to be psychic, because there are going to be days when there might be a crash, and then you wait too much, or something comes out in the news that you don't be aware of. So I think what you really need to do is just stay invested. Let the compounding work for you. If you keep waiting, you just don't know. You're not... companies or world events come out where we don't know everything that's going on. There are things out there now that have predictive analytic tools. I myself use for kind of timing markets, or I see what the future predictions are. It's a company called Hedge Trade, HEDGTREADE. It does predictive analytics, so it's kind of a quant research tool that is used it takes market intelligence, goes into algorithms, and this is becoming quite popular now with investors, especially professional investors. But I would say is that if you're trying to time the market, like, I want to buy something, and let's say like a stock that drops in price, and then you buy that stock that's cheap. And I've done this myself. I really like the stock that went up, and I loved it. It was an AI stock. I bought it, and then it just kept going down. And then you realized it was kept going down was because the CEO had a sickness. And once a company like that loses their main driver, their CEO, who's the innovator, it's going to take many, many years for that to get back up, right?
Okay.
So timing the market, I don't suggest it. I would say do dollar cost averaging if you want to.
Okay.
If you really like something, go and buy it and just let it run for the time being.
Okay, we've spoken about this, how many percent we should spend on saving and investment and whatever. But dollars and cents, how much money do we start with $50, $100 a month. What is?
If you
Is that worth it? Even
It is.
$50, $100 a month?
If you can do even $50, $100 a month, so just if you're in a diversified stock portfolio, 10 years, $50 a month, and 10 years is $6,000. Estimated value, if you invest that properly, is $8,200. If you do 20 years of investing $50, that's $12,000. Estimated value is going to be $22,900. You're going to get a profit of almost $11,000 if you're in a diversified stock portfolio. $50 a month for 30 years you're going to save about $18,000. That will be an estimated worth $50,000, and that's a $32,000 profit. So
anyone listening now who is 25, 28 years old,
start doing it.
Yeah.
$50, forget about it, put into something. You can start conservative, you can do aggressive growth, but the point I'm trying to make is that everyone needs to start investing at some point.
Yeah.
Because you're missing out the opportunities, but you just need to make sure that you're comfortable and look inside yourself about what your risk tolerance is. But there are ways to make your money grow, just not leaving it in a bank.
Wow, you don't realize the money until you actually do the math. What happens then if we invest money and then suddenly need it? Is this where all the charges come in if I want to pull out?
So this is where you want to, if you need money immediately, that's why you need to start just buy liquid assets. So that's like stocks that you can pull out. Usually you can get those back from 2 to 3 days, money market funds. Yeah. It's when you start investing, like, your property is going to be illiquid, so if you're really heavy in property investing, then you need some money all of a sudden, then that's going to be, that would be a problem. Some of the ILPs have surrender charges, and that's where you can lose a lot of money. So you really need to understand and read the fine print of your investment of when you can get that money out, so you're not sitting there losing a bulk of your investment over time. Okay. So this is where it's good to have your emergency fund, have some money in cash, have those emergency credit cards if you really need something that urgent, if you really need to fall back on something, let's say it's an emergency, medical emergency. But that's why you should have insurance. So keep money in liquid investments like stocks, money market funds that you can sell, ETFs as well. You can sell those on the exchange. So have that money available if you need that. But yes, it's not locked up for long-term investments. Like if you get into some structured notes, if you get into VC funding, some funds like in private equity, you have to hold 8 to 10 years. But that's really more for accredited investors. That's a bit more for professionals. Yeah.
I think for the older Singaporeans, many of us are very, very conservative. When it comes to investing, Singapore stock, international markets, ETFs, property, can I do it, say, okay, look, I just want Singapore stock? Or do I have to have this whole diversified selection, so to say?
So this is where you should feel comfortable in what you're investing into. So if you're very familiar and you read the newspaper and you're in Singapore and you feel that Singapore stocks, yes, they will be sufficient enough. If you don't know anything about a market and you go and buy something in I don't know, Italy market that you're not really familiar with, and you just hear a tip, but you don't know the reason behind that, this is where you really need to understand the company and do your due diligence, because
hey, hold the thought. Well, we'll go back on air and I'll ask you that question and we can deal with it again. Bon Jovi, Living on a Prayer. I know sometimes when you invest, it seems that way because you've made mistakes and you're suddenly going, "Oh Lord, what?" So I was saying to Matt on Facebook that especially with some of the older Singaporeans, we're very conservative. So do we need to have that diversification of international markets, ETF, property, Singapore stocks, or can we just say, no, I just want Singapore stock. I just want Singapore stock and Singapore property.
Yeah. So like I said, I think the person needs to be comfortable in the market they're investing into. So if you only feel comfortable in Singapore market, there's plenty of Singapore companies that pay good dividends. There's growth. the MAS injecting $5 billion into the stock market for growth. This is the things that you see that's encouraging.
Yeah.
If you feel that the U.S. is too risky, and I can understand that because the news changes there every day, then don't. If you don't feel like that, but if you feel like, what, I look around my house and every product is Apple, I'm okay to buy Apple, then that's what's going to happen.
Yeah.
Is everyone using Google? Is Google going to be, or is we going to all be driving Teslas someday? Then maybe I should get some exposure to Tesla. I think it is how you feel comfortable and willing. So I'm not saying go put all of your money into those stocks, but having some exposure, yes, your money's going to grow as well. But feel comfortable what you're investing in. Feel comfortable in the country you're investing in as well.
I think one of the main reasons one of the main things you learn from this is you have to know yourself.
Yes, I wanted to say one hack that I think is very useful for those in the retirement. If you have an SRS cash balance,
okay,
and that's where you can put money for tax savings.
Okay,
very good tip that came out at Phillips Security where I work is that if you sweep that into a money market fund, because SRS count gets 0.05%, so you're just having money sitting there idling out or anything, you can invest in these money market funds and actually get higher percentage rate for just doing nothing. So these are kind of things where you can look at where your money's sitting and do small things to get larger returns down the road.
Right.
So I think that was a very good one that kind of came out, that if you can have a money market fund and sweep that into your SRS and sweep that into a money market fund, you're going to get some of these money market funds are getting 1.5-2% already. So that's a win.
Awesome. Matt, thank you so much for being with us. How does anyone contact you if they want to?
Yeah, so I appreciate all my time here. I will be taking all of my episodes and launching my website.
Okay.
It's going to be MatthewANixon.com in early 2026.
Yeah.
In the meantime, you can find me on Instagram at Matthew A. Nixon, or you can also look at me at LinkedIn. And also, I am a financial advisor with Phillips Security. So talk to Phillips. I'm on their website as well, Matthew Nixon.
Awesome stuff. Thank you, Matt. It's been an amazing 10 weeks.
It's been great. I love being here. I'm going to miss you guys, but have a good Christmas, and maybe sometime in 2026.
We will pull you back in for sure. Thanks,
you,
Matt.
guys.
You have a great future. Have a great Christmas.
Thank you so much. You guys have a good Christmas too.
Just up.